Despite ongoing uncertainty in the financial markets, hedge funds have made progress in 2012, with many institutional investors seeing inflows outpace outflows and new funds come to market. Today I'm joined by Sanjiv Kumar of Fort LP to discuss investment plays and where the industry is heading. Fort recently won the World Finance Award Best Managed Futures CTA Fund in North America for 2012. Sanjiv, welcome and congratulations.
Thank you very much, Nick.
Fort has an excellent performance record, and your global diversified fund has returned 18% a year since it began 18 years ago. Give us your sense of your investment philosophy.
We tend to trade mainly the directional moves in the market. We focus on trading interest rate, currencies, stock indices, and commodities. But when we started 18 years ago, we said we're going to follow four major themes in all our strategies. The first one was we always wanted to have investments which are very liquid. And so we gravitated towards the futures markets. And as a result, we can provide daily liquidity in our funds. The second thing, we decided we're going to follow a systematic strategy because we felt that a lot of opportunities that arise in the markets are because people make errors all the time, and human decision making is, in our view, very flawed when it comes to investment decisions. And we felt the systematic strategies can stay unemotional and can take advantage of this weakness in human behavior. And so we've tended to stay with being fully systematic. The third thing we try to do is to build simple models. And generally the biggest problem in systematic strategies is people build complicated models, they fall apart. And so we try to build simple models, wrap them with some sophisticated statistics. And finally, what we have tried to emphasize that all our strategies be somewhat unrelated to what's happening in the stock market. And that makes it a very nice addition to anybody's portfolio, especially given the last decade or so where stock market has not really produced any real gains. And I think what we do can really help people.
This point of human indecision is an interesting one. So how does your contrarian fund differ from your diversified fund?
We follow three strategies in a diversified fund. The trend following, trend anticipation, and short-term mean reversion. The contrarian fund only does trend anticipation. And the reason for that is trend anticipation is a very unique strategy. The most dominant strategy in the space is trend following, which is about waiting for evidence to get into a trend and waiting for evidence to get out of a trend, which has superior long-term record. But there is a problem at times where the trend ends and the manager suffers a little bit of losses at the end. But we felt maybe we could do something differently, which is to have a strategy which tries to get in early into a trend and get out early, and that's how trend anticipation came about. And also trend anticipation is just a strategy which we call contrarian. Has just finished its 10 years in business, and we've roughly done 14% a year over those 10 years. And the strategy has not had a negative year, which has also been a very appealing factor. A lot of our asset growth has come through the contrarian strategy, as a lot of the large institutional investors prefer that.
The last couple of years have seen a debt crisis. So how have you managed to find returns in what has been a difficult period for most managers?
The debt crisis has changed the behavior of a lot of investors. People who used to be a lot patient in the past are no longer patient. And as a result, everybody is trying to control their risk. And so what has happened is that a lot of the investors, on even the slightest bit of change in the news, look to jump out of the market or jump back in. And a lot of managers have tried to have very tight stop-loss rules. In this kind of risky, volatile environment, a lot of them are getting stopped out on their trades. So we've always believed that one-off events should not really push us out of our positions. So we've tended to be more patient. And as a result, we've navigated this environment a lot better. I mean, the last 2-3 years has been a very profitable period for us. Not only have we avoided getting stopped out on many of our positions, we've also been able to take advantage of some of the moves, especially in interest rates, who have come down pretty sharply. And so, we feel very fortunate to having survive this period, but it's a period that's worked well for us.
Do you think the regulatory environment is going to change in the next year, 2 years?
I think it's quite possible. We've already seen some curbs on trading in equities in Italy and Spain and a few months ago in France. And it's quite possible that if situation gets out of control, we start getting closer to default, or a lot of governments start having trouble financing, we'll find that governments will impose further controls. Clearly, the central banks have been trying very hard to do a good job, maintain liquidity in the system, make sure the system doesn't freeze, but I think many of the politicians have not really helped.
So faith in the central bankers, less so in the politicians. What's next for Ford?
Yeah, Ford has to reorient itself a little bit. We have been so far reaching out mainly to fund of funds. The fund of funds are going through a difficult period. They have not performed quite well over the last few years. And so many of the end investors are thinking maybe we should just reach out to investors directly. And so we have to try to find ways of reaching out to them ourselves. So we are building up some staff to do that. We're also launching a UCITS fund, which many of them prefer given the regulatory comfort they get from the UCITS environment. And so we hope we'll have many different offerings which will make us reach out to them directly. And that's what we are working on.
Sanjiv, thank you.
Thank you very much.